Okay, Lawrence Cunningham, welcome to the Tailwind Podcast.
Happy to be here, Andrew. Thank you.
So, we're going to talk about your book, The Essays of Warren Buffett, which is a compilation of his shareholder letters, sort of organized by different topics. Could you tell us about your background and how you have collaborated with Warren Buffett over the years?
Yeah, sure. I have been very interested in both investing in corporate governance my whole professional career, and the overlap between those two fields is, I think, extremely important, often underappreciated. But Warren Buffett has seen that overlap throughout his career. And when I was a young professor at Yeshiva University in New York, they put me in charge of the corporate governance program. And the dean said, your job is to produce high visibility events and publications. And so I scratched my head a little bit and finally came up with the idea of posting a conference about Warren Buffett's letters because it had the governance dimension and also this investing dimension. And so through friends of friends, I connected with Warren, and to the surprise of many, he agreed to participate in the conference and allow me to arrange the letters and then later publish them in a book. So that was about 25 years ago. And we've updated the collection every 5 or so years on average to reflect new developments and get his views, incorporate his views on new aspects of old problems, let's say. And so it's been the honor of my professional career to publish this book. But I've also been a professor and a lawyer and written lots of other books about investing in governance. But this is by far my favorite project of all time.
That's awesome. So first of all, why does he write these letters? Like, why did he originally start doing it, and why has he continued to do it in the same way?
He started writing letters to the shareholders of Berkshire Hathaway in 1978 for the explicit purpose of attracting shareholders who would share his unique philosophy about business and investing. And that unique philosophy includes a primary focus on long-term business execution. So he's not interested in stock market prices, not interested in short-term ups and downs in stock market prices, and really so he wrote these letters to explain his philosophy. And the goal was that he would attract to Berkshire Hathaway mostly shareholders who understood that special perspective. And he's kept them up to date because it's critically important to retain that shareholder base and to deter others, to discourage short-termers, arbitrageurs, even indexers if he could do it. And I think he also enjoys it. I mean, that was the purpose or the end he was trying to achieve. But I think he also really likes to think. He reads a lot, and I think he enjoys the writing and enjoys seeing it all come together as well in this book.
I think the book in many ways is sort of a journey into his mind and his thoughts on business and his values, which I think are very overlapping. I think they sort of inform each other. His values sort of inform his investment philosophies. Just to set the stage, let's start sort of biographically about Buffett and Berkshire. So Buffett's from Omaha, smart young man, ends up learning under and working for Ben Graham in New York, returns to Omaha and starts an investment partnership, basically managing the money of sort of friends and family and some people in the community there. And over a period of 10 or so years, he does very well running this partnership, basically picking stocks, outperforms the indexes and all of that. However, one day he decides to essentially dissolve it and offers his investors shares in a textile company that he just bought called Berkshire Hathaway. So why did he wind down the investment partnership?
Well, I think his partners included some people who stuck with him, most prominently Charlie Munger and Sandy Gottesman, both of whom acquired substantial holdings in Berkshire Hathaway. And I think all of that, and so it wasn't just Warren deciding on his own, but I think all of them recognized they had had a good run and really liked, trusted, and admired each other as a group. They never got in any fights or any arguments or anything like that. And I think it was opportunistic. It wasn't a plan that they had devised over long periods of time that they would eventually do it this way, but it was an opportunistic acquisition and pivot for them. And Warren took the largest share and took the lead, took the reins of the organization as the CEO, but the other fellows stuck with him throughout the whole journey, many of them as members of the board of directors, and in addition to being significant shareholders.
Got it. And so now he's running this textile business. And Over time, he ends up sort of creating a structure that enables him to buy stocks as part of the business without sort of running an investment fund. How is Berkshire structured such that he has the cash to go buy stocks?
Excellent point. You mentioned that he went to work for his mentor, Ben Graham, between sort of business school and returning home to Omaha. And one of the things he learned with Ben was the appeal of insurance businesses, in particular Geico, the car insurance business, which Warren really was one of his first deep dives. He published an article in a investor's finance journal explaining the economics of the insurance business and the appeal of Geico and what he was talking about and what he's done. And the answer to your question was he acquired and has acquired many insurance businesses and has implored his underwriters in those insurance business to exercise insurance discipline, underwriting discipline, so that they price risks fairly but accurately and generate premium volume in excess of claims to be paid. And that excess, the company is able to retain and hold in the event that it eventually needs to pay claims and can invest those funds. And he calls that float. This is an attractive source of capital for a savvy investor like Warren, because given the underwriting discipline, there's a very good chance that that money won't be needed to be withdrawn and paid out to policyholders. And instead, he could invest that capital in stocks, shares of individual businesses on the open market, or businesses, 100% or huge majority of operating companies. And that's what he proceeded to do. And several features of float make it attractive, at least when you're owning an insurance business that's run with underwriting discipline. First, there's no interest rate. People who finance investments with borrowed money have to pay the bank a certain fee, an interest fee. Insurance doesn't require that. Insurance float doesn't have an interest rate associated with it. Also, when businesses borrow, they make promises to the lender, covenants to a bank that put some limits on their operating flexibility, additional acquisitions, operating leverage, and other limits that insurance doesn't carry. And so it's a lot more flexible. And third, there's no specific due date. With loans, they have to be repaid. Even preferred stock, let's say, an equity instrument typically has a maturity date, so you've got to repay it. Insurance float doesn't have that. You might have claims obligations to pay, but there's no fixed end date. So he found these features of float that arise from an insurance business extremely attractive, as long as you're exercising underwriting discipline and generating that float in a conservative manner. And then on the investment side, he was able to buy common stocks and whole businesses using that capital. Then in that part of his structure, in that part of his business, he likewise exercised extraordinary investment discipline, examining companies with deep fundamental analytics and insisting to himself that he only evaluate businesses that he could really fully understand. He didn't want to wing it or go out on limbs. And so he tried to stick within what he calls his circle of competence. Ben Graham also taught him, very importantly, that stock market pricing is often accurate, but sometimes it's wildly inaccurate. And when the price levels are low, that's a really opportunistic time to wade in and buy. His old joke about being greedy when others are fearful. That's what he's done. And being fearful when others are greedy. That's what he's done too. And so with disciplined investing, he was able to buy a lot of common stocks of good companies with good fundamentals on the cheap. And that obviously increased the scale and scope of the business. And soon enough, he was finding small businesses that he could buy Berkshire could buy 100% of. And they did that with the same discipline and the same philosophy, the same sense that we are going to own this company. It's got to be within our circle of competence. It's got to have good fundamentals. And above all, we plan to own it forever. That's been the somewhat simple philosophy, simple to state, hard to state disciplined in each of those aspects. But they've done a very good job of that over a very long period of time.
There's a bunch I want to hit on there, but I think that last point you just made, just about discipline, does he have superhuman discipline? Because I just cannot imagine someone who's had that much investing success. I feel like at some point you would be tempted to deviate from the values that he sort of holds dear about staying in his circle of competence, waiting for Mr. Market to sort of do its thing and send a certain company's stock price downward. But he seems to have been able to sort of stay true to what his initial investing values are. And you can see that in the book. He basically says the same thing for 40 or 50 years in terms of what types of companies that he's looking for and what his investment philosophy is. It changes slightly, and I want to get to that at some point, but I'm just curious just to hear your thoughts on just his mindset, his internal discipline, and not having deviated from what he thinks works well.
Yeah, you're absolutely right. That's one of the beautiful things about his letters, that when we update the book every 5 years, it's not because the philosophy has changed or any of the principles have changed, other than maybe the incremental evolution that you referenced, but because the world has changed, and it's neat to see how those old principles still apply, whatever the change is, whether we're in a dot-com bubble, a real estate bust, a CSR world, that is corporate social responsibility world, or ESG world, or whether indexing or ETFs are the flavor of the month, those fundamental principles have stayed the same that whole 40 or 50 years. So it is remarkable to see. And one of the jokes that my friends and I, who go to the annual meeting every year, this is the big annual meeting in Omaha, Nebraska, of Berkshire Hathaway shareholders. I've been going for 25 years, right after I published the book. And the first several years blew me away because I learned so much. Everything was relatively new and interesting, and I sort of put it together. But after about the seventh year, I knew the answers to every question. I knew what they were going to say. I knew how to think in these fundamental owner-oriented principles. In fact, Charlie Munger, his vice chair, joked to me after about that seventh meeting. He said, "Well, Larry, you got another dose of the catechism," which is a neat way to put it, because it's a set of ancient, durable principles, and it is important, coming to answer your question, to maintain some discipline in adhering to them. And it's not easy to do that. And Warren hasn't always done it. He's always said it. He's said the same thing over and over again. He's violated some of those principles over the course of his career. And he admits to it. He admits to straying, to making mistakes. He made lots of investments over a decade or so in lots of different airlines, which is one of the most difficult businesses with the weakest economics, some of the biggest problems with logistics, scheduling, labor, fuel. He just kept making that investment. It was one company after the next, and he finally just fessed up to it all. I said, I got to get out of that. He did end up buying a fractional aviation company, but I think he skipped those airlines. He bought a couple of insurance companies that were mistakes in certain ways. They bought a very large reinsurance company in around the late 1990s called Gen Re, and he paid for it using Berkshire stock. So it was something he tells himself don't do, but he's done it a couple of times. He tells himself don't do it because Berkshire overall is an extremely high quality company. Almost no other company they buy will be as high quality as Berkshire itself. So trading your stock for another business isn't wise. And so he kicked himself for paying stock for the Gen Re. And the other thing he did wrong, I guess, or the mistake he made, is he accepted some risks. He acquired risks that he didn't really fully understand. That company was deep into the complex financial derivatives market and had a book of business that was impossible to understand. And Charlie even told him when they were thinking about making the acquisition, Charlie said, I wouldn't do it because I don't understand how those derivatives work. I don't understand the risk they're taking, the pricing they're doing. It just looks dangerous. And Warren went forward with it anyway. It was a huge acquisition. And so they bought it, and Munger was right that these risks ripened in surprising and massive ways. And it took years, 7 or 9. And Warren helped his insurance mavens kind of unwind a lot of these things. He recounts several other mistakes. I don't want to take up too much time, but the key point is that you're right that there are a relatively small number of fundamental principles, maybe 10 or 14, that he articulates over and over and over and over again, and has generally adhered to them. And that has been a big part of his success. But his case study shows that it's easy to forget the principles. It's easy to violate them. And he has done so on a few occasions.
It is. He talks about this. Part of the reason why it becomes tempting to deviate from them is because there might be somewhat long periods of time where he just doesn't see a business or an investment that checks all the boxes he looks for. And to some degree, he just has to be very patient, and you could be waiting years for one to emerge that sort of checks all those boxes. So one of the things that does change in his investment philosophy, and he repeats this line many times in these letters, he says he wants to buy an outstanding business at a fair price rather than a mediocre business at a bargain price. I think that philosophy was sort of influenced by Munger. How did it represent a departure from what he did earlier in his career?
Excellent. Ben Graham, who we've mentioned a couple times, was Warren's mentor and professor in business school. And Ben Graham was an advocate of buying cheap. He wanted to buy at the lowest possible price. He would even buy a dying business if the price was low enough. And this practice got the nickname of cigar butt investing, that you pick up the last part of a cigar, the very last end of it, get a couple puffs out. If you got that for a low price, you made money. And so Ben was a practitioner of that sort of investing, and that's what Warren learned. So he was looking for low price, even if it was a poor business, bad business. And Charlie's inspiration said, well, if you're just going to think about this year or next year or the year after, then those cigar butts might be fine. But if you're thinking 10 years, 20 years, 30, 50 years, you don't want to just keep buying cigar butts all the time. You've got to look for companies that will prosper over that very long horizon. And companies that are bound to do that are not likely to be cheap. You may have to pay, and you'll certainly have to pay more than the Ben Graham cigar butt. You'll have to pay some premium. You still don't want to overdo it. You don't pay a bonus to acquire a durable business, but don't be so focused, so obsessed with a super duper low price. And that was how they came up with that phrase. It's better to buy a great business at a good price than a good business at a great price. Or you can substitute different words. I use good and great just to keep it easy. It'll be wonderful and mediocre. You could substitute, but that's sort of that's the framework, and that's the pivot. And you're exactly right. I think it's Charlie's influence on Warren, and it manifested most conspicuously in their acquisition, I think it was 1972, of See's Candies, a California-based chocolate maker that had a brand name and competitive advantage in its loyal customers and its marketplace and its manufacturing practices and things like that. So it was a really good business. It had a brand, a durable advantage, and they weren't going to sell it for cheap. And Charlie knew about the company, I think, lived in California. So we're going to pay a little more than you might have paid on your cigar butts, but this will pay off long term. And that, I think, is the break point in the Berkshire history. And it turns out in the history of Berkshire to be a relatively small acquisition, but a very large acquisition intellectually.
So that investment philosophy, and totally, he does use different words throughout the letters too to assign a wonderful business or an outstanding business. He does sort of switch it up, but that philosophy, in my mind at least, fits very well within the Berkshire Hathaway structure, where they're not a hedge fund. They don't have to worry about redemption notices coming in 12 months or in 3 years. So if they buy a business that is a great business that has long-term competitive advantages and is going to compound at high rates over decades, they don't have to worry as much about the entry price. It's still certainly important, but because they're not worried about selling those shares 1 year from now, as long as they get into the business at a fair price, they don't have to time it exactly right. And so that sort of structure piece brings me to Berkshire Hathaway A versus Berkshire Hathaway B. So for a long time, they did not want to do a share split or offer a cheaper stock. So why were they reluctant to do that? And then why did they ultimately decide to launch Berkshire Hathaway B?
One of the reasons they were reluctant to split the stock was, going back to our first question and answer, is that Warren wants to attract to Berkshire Hathaway long-term focused investors. So he wants his ideal shareholder is someone who buys Berkshire stock with the intention of never selling it until they die or send the kids to college. And over the years, he looked at the trading volume in Berkshire stock, and it tended to meet his goal. People did not sell it very much. There was some selling, again, for death or taxes or education or something, but people weren't buying it and selling it and trading it like is done with a lot of stocks. And the stock price had been more steadily rising throughout the period, 80s into the 90s. And so the stock price was priced kind of high. And there were people in the marketplace who admired Berkshire, but didn't really want to hold it forever. They wanted to buy it and then hold it for a bit, watch that price go up, and then sell it. And but a lot of traders with that appetite were scared off by the high stock price. I mean, it got into the 4 digits, which was a long time ago. It's now 6 digits, coming on 7. But I mean, It was a very expensive stock. So those day traders were deterred from buying the Berkshire stock, which suited Warren very well. But on Wall Street, if there's demand for something, some genius will supply it. And in this case, a couple of financial whiz kids said, "Oh, let's create a synthetic Berkshire." Basically, they were going to create, and organize a trust, and the trust that they ran would buy a chunk of the expensive Berkshire shares, and then that trust would issue fractional interests at a low price in those shares, and so lots of people could buy Berkshire and they could trade it and do all those things that short-term people like to do. I think that they asked Warren, or in any event, it came to Warren's attention, and this was anathema to him, that having that kind of trading environment through this trust would affect Berkshire stock, and it would attract a different kind of shareholder than he wanted and that he had. And so I think Charlie Munger was the lead architect of this idea of, well, let's create a second class of stock that we'll be able to design and we'll be able to control it, and it'll have sort of a ratio of, at that time, it was let's say a fraction of the voting rights of the original class and a fraction of the economic rights, and it'll trade proportionally at a lower price. And so people who want to do that can, but will still very much protect attractive features of the primary stock. And so they did this plan. They executed the plan called a recapitalization. And so the existing long-term stock was called the Class A, and the new shares were called the Class B. And there are billions of the Class B outstanding now. I think just still millions of the A. And so the A became very expensive. That's the stock that's trading at $700,000 a share now, and the B is $500 a share or something like that. And so it warded off. So this destroyed that voting, that trust idea that those guys were trying to do. So it just absolutely paralyzed that. There was no point in it. People could buy. I think initially the share of Berkshire was $50 or something. It was so people could buy it. There was a little bit of trading, a little bit of that noise in there, a little bit of that trading, but it was small compared to the overall Berkshire. And it's worked out pretty well. I think they split that stock, the Class B, when they bought BNSF. They had to reduce the fractions, the relationship of the B to the A in terms of votes, in terms of economic rights. The other neat thing that they did is, and this was another reason for it, they recognized that as the A got extremely expensive, it was increasingly challenging for long-term holders to do their estate planning, to pay taxes upon death, to pay for kids or grandkids' education. And so they in recognizing that, they made a provision that the Class A can be converted into the Class B. And so a wealthy long-term family might have 100 shares or 200 shares of A, and they just need $100,000, $200,000 for some kid's education or paying taxes or something like that. They can convert one share. And so that was another reason they did it. And you cannot convert a group of Bs back into A's.
Right.
So you want to keep that sort of long-term feeling. The way it's working now, the A's tend to be held by the most loyal, most focused, most long-term investors, who Warren calls quality shareholders. And I've used that word too. And other types of shareholders, whether it's the hedge funds you're talking about, the arbitrageurs, day traders, even index funds, will tend to be in the class B.
Mm-hmm.
So the neat effect of that is little understood and little discussed, is that as Warren gradually, in his estate plan, he's gradually selling down his A's. He's converting his A's into B's and then selling the B's into the market. So as he reduces his percentage ownership, the percentage ownership of those continuing Class A shareholders, those quality shareholders, increases. And so that group, it's not going to be one for one, but that group will tend to have the same control level as Warren has had after he leaves the scene. I mean, it's a little different. It's 18 or 22 of them or something like that. And that, I just don't know. I'm pretty sure that Charlie and Warren and the law firm that helped design this back in 95, Munger, Tolles, and Olson, including Ron Olson, the head partner there, I think they envisioned this neat long-run effect when they implemented, but the primary reason they did it was to halt these Berkshire clones, that little trust. But it's going to have this hugely valuable payoff in the next decade or two.
In these letters, he calls out a lot of what he views as improper practices in the business world. And he calls out a lot of different groups and entities, investment bankers, the alternatives industry. He's not afraid to call people out in these letters. Yet it's, at least from all I know, it seems like he hasn't made a ton of enemies in the business world, which is impressive. There seems to be a lot of sort of virtuousness that is tied up in his investment philosophy and just his view on the business world. So one, do you agree with that his investment philosophy sort of contains a lot of virtuous principles? And do you think, if yes, do you think that's part of the reason why he has such a sort of passionate fan base?
Yeah, I think so. One of those principles, incidentally, is the old saying about praise by name, criticize by category. You're right that he's critical of a lot of practices and a lot of professions. Occasionally he'll mention a firm, but he almost never mentions a person. And so he's critical of investment bankers. He's critical of hedge funds. He's critical of arbitrageurs, of certain takeover artists. But he rarely mentions a person. I think there may be a couple who were like notorious. I think he mentioned Ivan Boesky once in a somewhat derogatory way. He recently passed away. He was a notorious insider trader. But he doesn't call out individuals and mostly he doesn't call out firms for criticism. For praise, he does. He praised Solomon Brothers, his long-term investment bank, praised the New York Stock Exchange when they listed his shares, and praised many members of his board and his CEOs. And so I would call that a virtuous practice or a virtuous principle. And I think you're right. That's one of the reasons people like, trust, and admire him. Even people who may not agree with him or people who've been on the other side of trades or transactions or events where it might be a natural enmity, still I admire him. And there have been plenty of people, on the other side of various events over that 40 or 50 years that they would call them frenemies instead of enemies or friends. And I think that behavior, that character is attractive to people. And I think that is a part of what attracts the fans, if you like, the Berkshire shareholders. It's a version, again, of when I quoted Charlie's quip to me about the meeting being catechism. There are some religious type of, virtue principles about the philosophy. He said, do unto others as you would have them to do unto you. I mean, his practice in corporate disclosure, for instance. Another reason he writes these letters is that he's trying to provide information to his investors that he would want if he was the investor. And so there's this mutuality principle, which is a virtue. And I think that he admonishes his troops, his team, everybody in the company to take that kind of stewardship seriously, to appreciate that we're managing other people's money and we have to be faithful fiduciaries with that money. And so what does that mean? That means we never cut the corners. He likes to talk about playing in the center of the field, not skating to the edge of the ice. This wonderful story that encapsulates this and that's been brought down through the decades was in the early 90s. that banking firm I just referred to, Salomon Brothers, which was one of the best banks in the world, had a couple of crooks inside of it who decided to corner the bond market, U.S. Treasury market, in violation of all sorts of fundamental laws, criminal conduct, and they got caught. The upshot almost did ruin that bank. And Berkshire, that investment firm, Berkshire had nearly a 20% position in some preferred stock, I think. As the company was being crippled, there's FBI investigations, U.S. attorney investigations, and people going to jail. But the goal is to try to save the company. And so the board of directors, in trying to figure out, well, what are we going to do? How do we steady this ship? Asked Warren to become chairman of the board. He reluctantly agreed to do that. And this was early in his career, but he had already established the reputation for righteousness or virtue or ethics that you just referred to. And in testimony in Congress, he was called down to Congress to testify about what happened at Salomon. What's he going to do about it? In that testimony and also in the trading room, got all the traders, all the employees together. And in both of those settings, he gave this admonition that makes my spine tingle every time I hear it. He said, "Ladies and gentlemen, my employees here, if you lose money for the firm, even if you lose a lot of money, I'll be understanding. But if you lose reputation for the firm, even a shred of reputation, I'll be ruthless." I hope your spines are tingling too. I mean, just picture you're in this trading room, you're scared, you're worried, you've got police officers, in your desks and stuff, and your colleagues going to jail, and you're worried about your job, your career, and your future. And a guy like this comes in and says, we're not going to come close to that kind of stuff anymore. And you can make mistakes, ordinary mistakes, business mistakes, but you cannot make moral mistakes. And that helped rehabilitate Salomon. It got back on its feet. It was eventually then soon after sold it into Sandy Weill's empire that became Citi. But that mantra stuck with Berkshire Hathaway. That's just something everybody up and down and across that company gets. Yes, I think you're right that that's a reason why a lot of people find Berkshire attractive. That's part of the culture. It's part of the ethos. It's part of how that company wants to do business. And all of that said, there are going to be miscreants everywhere. And you're going to have problems, especially in a company of this scale and this degree of decentralization. So you're going to have jerks here and there, but you have far fewer of them in a place like that. And if you're an investor, that's very attractive. You may lose some money this year or next year. As long as you keep your reputation intact, and over the long term, you'll probably recover that. So you can't recover your reputation. So I think you're absolutely right about that. And some people the flip side of that is there are some that rubs some people the wrong way. Some people think it's too moralistic. It's too even self-righteous. Oh, well, they're the people who are always getting everything right. And that it's not true, but people who have that feeling that they're just supercilious moralists, that rubs them the wrong way, that they don't like them for that. The big price that Berkshire has to pay is that the tiniest whiff of problem gets laser focused by the press, by stockholders, by others. So an infraction at this subsidiary or a bad actor at this company attracts enormous media attention. And so the effect on Warren personally, but all the leadership there, is they have to be way more careful about everything they do than CEOs or board members of mainstream companies that don't have that reputation.
On a similar note to just the virtue point, Buffett seems to be, in the letters, he's sort of keenly aware of just different sort of human psychology principles. And obviously, psychology is a huge thing for Munger. But he talks about, for instance, in the acquisition section, he quotes Peter Drucker, basically, who says that the reason acquisitions happen so often is because deal making is fun and working is not. So if you're running a business, you'd much rather go buy a business because that's deal making than actually try to figure out how to improve your business internally. So Buffett, in these letters, he references a lot of different psychological concepts like that over and over again. To what degree is that those type of psychological observations, is that influenced by Munger? And to what degree is that also just how Warren sees the world?
Yeah, absolutely. I think psychology is probably the most powerful influence on investing, and you can't purge it. It's impossible to excise it. So all you can do is be aware, test. One of the things Warren almost always did before he made any major acquisition was submit it to Charlie for a test. He almost always listened to Charlie. He did in that one episode with Jen Ray we talked about earlier. He did not, and he paid a huge price. And Munger knew Munger's own psychology would sometimes tempt him to decisions that were patently irrational, and he would check his own decision making by running it by Warren. And this problem appears in general investing and especially in acquisitions for the reason you mentioned, that it's fun to buy a company. and so it's a lot less fun to try to operate one generally. And so Warren has trained himself, I think, to be disciplined, to have a sounding board, to run things by somebody. And Charlie's passed away. He'll do that with Greg Abel, who's the vice chairman and successor, or other people who have the relevant knowledge. So you're absolutely right. I think we all ought to be a little fearful of our own psychology.
Mm-hmm. Yeah. Okay, two more questions. So let's talk about the American tailwind. Do you think Buffett has sort of become the ultimate optimist at this point in his life after seeing the world on a knife's edge, seeing America on a knife's edge so many different times, and then often looking back and lamenting that he maybe sold shares out of fear and sort of bought into a lot of the fear at the time? And now he has come to the realization that the world people tend to sort of back off from the cliff's edge. Things get better. And of course, as he points out, the market keeps going up. But I guess my question is, do you think he has sort of become the ultimate optimist?
If you're able to have a long enough time horizon, then optimism is a logical ending point. And I think, he has that long-term view and has the self-discipline and then the structural or organizational discipline, patient shareholders, long tenured managers. But I think he recognized over short periods of time, there's going to be surprising adversity of many different sorts. And there's a wonderful passage in the book when he reviews all of the catastrophic, cataclysmic, volatile events of the 20th century. A couple of world wars, a Great Depression, a couple of small wars, proxy wars, terrorism, inflation. And yet there has been prosperity across all that adversity. And the principles have been unchanged. None of those calamities have altered the fundamentals of long-term focused, value-based investing, quality investing. And so that enables, if with that framework in mind, then optimism for the next 5, 10, or 20 years for the kids and the grandkids is warranted. And I think that's what he demonstrates in that passage, in that chapter in the book about American tailwinds, is the institutions of our system. So you might have a different assessment of long-term prosperity in some other countries that are not democratic, that are not capitalist. But in the American system, with those two driving features, he is so grateful for having been born here and had the chance to live and work here. He thinks that whole is wonderful. Those sections on the American tailwind, I think, are some of the best in the book. And I think they are they're historical, but they're very important for what's coming next, and especially dealing with a lot of the turbulence that this country is currently in the middle of. We can expect some more of that in the coming years, but when you are able to look over the horizon, I think you can defend optimism.
Yeah, and I think those sections too have a sort of built-in humility to them, because he's basically saying, like, yes, I've done well, but I also have had a huge American tailwind at my back, basically. And last question for you. So how has knowing Buffett and Munger and knowing their philosophies so well impacted your own investing, if you're willing to share that? And the sort of context behind that question is, I know there are some people who view their strategy as optimal, as the sort of best way to do it. And then others who look at it and say, okay, I can see why this works for them. It's not going to work for me for certain reasons.
Yeah, well, it's helped me a lot. And I mean, I've taken the lessons and the insights pretty much to heart, so that I think about a circle of competence. I stay within it. I think long term. I don't do any day trading. And I have one thing we didn't talk about was that while he advocates this sort of focused fundamental approach for himself and to attract his shareholders, he also realizes that a lot of people can't conduct that kind of analysis, don't have the time, don't have the inclination, don't have the competence. And for them, it's better just to buy an index fund that buys basically every stock in some gigantic basket like the S&P 500 or the Russell 3000. And so for my purposes, through all my retirement funds at all the employers I've ever had, most of them are in those indexes. I have bought some stock pickers in that space who I know, Sandy Gottesman's fund, for example, and Kenneth, another Berkshire family member, basically. But for the most part, my retirement funds, those tax advantage deferred resources, I've left in index funds. And so I don't really have to think much about that. But for my sort of discretionary investments, I've been a stock picker. It's a concentrated portfolio. It's companies I know extremely well, including Berkshire Hathaway, companies whose boards I serve on. And it has helped me enormously, especially that bit of patience and the quality point, that point about better to buy a great business at a good price. I've done that and then sat still. So I'm getting old now, but I've been investing for 35 years and paying close attention to Berkshire for 30 and these lessons. So it has certainly influenced me and very helpfully.
Lawrence, thank you so much for coming on the podcast to have a chat, and fantastic book. I think I'm going to keep rereading it over the years. And yeah, thank you again.
Pleasure. Thank you, Andrew.